which is a concept that not many people talk about or really understand, and they end up being liquidity. So if you don't want to be liquidity, you need to make sure that you're understanding this concept here. So whenever, right, we create a high, traders, you guys have been asking me about external versus internal range liquidity, and in this video I am going to be giving you all the information there is to external versus internal range liquidity. We're going to be covering it in very much depth so you can learn to ride the potential market waves that are setting up ahead, because the market moves based on liquidity, and you need to make sure that you're aware of the different liquidity pools, how we can understand structure, and how we can take advantage of it. So this video is going to function as a full guide to external versus internal range liquidity. Alright traders, so here we are on the drawing board. As you can see, I've prepared some information that we're going to be going over, and I'm going to make this rather quick and effective for everyone to understand. So once again, when we talk about external versus internal structure, the very first thing that we need to understand is that the external structure, right, is dependent on the time frame that you use, which is to say that it varies depending on the time frame that you use. In this case, I've used the 1 hour as the external in red, and the green, the 5 minute, as internal. Okay, so external red 1 hour, internal green 5 minute time frame. Now, why does it change? Well, because it will always show a different external point depending on the time frame that you use, right? And that's why it's so crucial that within your trading plan you determine, hey, I am going to be using the H1 or the H4 or potentially the daily for my external, and anything lower than that is going to be internal, because the internal can never be higher time frame than the external. It's very important, guys. This is what creates a lot of problems within traders, and I will explain to you now why. So what you can see over here, and let's now refer back to the drawing, is that we have a structure, right? Red represents the 1 hour, and this is what a 5 minute time frame would roughly look like on a 1 hour external. So the external points are as follows: here, 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 here. Well, you get the point, right? The biggest swings on the hourly are going to represent your external points, which is where the market structure shifts and changes, right, as we break above and below these points. It's very important. Now, you're not considering any internal structure shift. As an example, I've prepared this example here. You can see that the internal structure shifts on the 5 minute, and we get a bullish break, and you might come in and say, hey, I want to buy a pullback into the breaker, and you get left out wondering, why does it fail and carry on lower? It is because you failed to understand where you were within your external leg. It's very important. Now, I will show you now the definition of a trend, which is rather important when it comes to understanding structure. The very first thing is, in order to have a trend, you need 4 structure points pointing in the same direction. So we have a low, we have a high. At this point, we don't have a trend. We just have a low and a high. Then we pull back, create a higher low, and the trend confirms itself right here. As soon as we trade above this high, we now have a trend, a bullish trend. We have the external points in red and circled in black, and we have the internal points in green, right? You can see them here. Very, very important to understand. Now, in order to create a valid pullback that's going to serve you as a valid, let me quickly get rid of this, as a valid structure point, you need to see a 50% retracement plus, which is a concept that not many people talk about or really understand, and they end up being liquidity. So if you don't want to be liquidity, you need to make sure that you're understanding this concept here. So whenever, right, we create a high, pull back, create a high, you understand that we have a bullish trend and you're looking to get long to ride the next wave, you first need to wait for the retracement. Number one, wait for the retracement here. Why? Because we know that above and below every single swing in the market, there is liquidity. And this is the process that the market repeats and repeats and repeats. Once it's done, collecting liquidity above swings, it will then pull back to favored demand zones, breaker blocks, order blocks, whatever you want to call them, to then resume higher, right? And as it's doing so, we need to understand that traders are getting stopped out above highs. Traders are being initiated long above highs, and that is the exact reason why we see the retracement take place to the other direction, because traders have been initiated above this high. So traders are now long here. People that were selling have now been stopped out. Now we've cleared the order book, the ladder, and now we can resume the trend bearish here quickly, short term. Once again, the 5-minute time frame during this period where the 1 hour retraces, right, will shift bearish. Okay, and you can take advantage of that. You can trade that as well. But I'm just showing you how the market really functions. As the 1 hour retraces here, right, which is a simple pullback, the 5-minute will shift bearish, which is to say that we will have more than 4 points showing that we have a trend. And you can expect this to carry on happening until we reach a higher time frame POI that's then going to shift the market back bullish into another high. And the 5-minute, once again, will be coming down. It then will start shifting, and we're going to carry on to the upside at that point. Very, very important concept to understand. Furthermore, in order to have a valid retracement and structure point, it needs to retrace to the 50% at the very least, which is to say, once again, let's imagine we've understood that we're bullish over here. We're now expecting the pullback, and we need to see it retrace to the 50% plus in order to create a valid structure point. Otherwise, if it does not retrace 50% or more, right, let's say we create a new high, we pull back minorly, and then we start to move up, you need to expect that that's going to be liquidity. Okay, and that liquidity is going to get taken out into the real structure point that is then going to shift the structure back bullish. Very, very important to understand. If you do not have a 50% retracement plus of the leg that created the new high in this case, you don't have a real structure point, and you should expect it to be taken out as liquidity. And once again, I know it may sound confusing as of now, but everything is going to get clear as we jump back into the charts. So the key takeaways here, once again, you need to decide on a time frame that's going to be your external structure. Okay, you need to know which time frame represents the external, because it does change, as I said, depending on the time frame that you look at. What I recommend, once again, to students in the past, I've done this numerous times, use the H1 as external, use the 5-minute for entries, POIs, and selection to go long or short. Okay, so with that said, we're going to be jumping back into the charts. I'm going to be showing you examples, and you're going to understand now very, very efficiently the difference between external and internal structure and liquidity, so that you can take advantage of it. So let's jump right back into the charts. All right, everybody. So for this last segment of the video, we're going to be taking a look at a market, and we're going to be going over the exercise of determining the external structure versus internal, so we understand where liquidity lies and how we can take advantage of it. Starting off, guys, we're going to get started here at the very bottom, and all we're going to be doing is following structure, applying the 50% pullback rule, and understanding market waves that you can take. So we start at the low. We have a low, we have a high here. Once we have understood that, we know that we have a low and we have a high. We don't have a trend yet. Yes, you have a potential shift here, but you don't have a confirmed trend. The moment we pull back, again, respect the previous external structure point here, and we go ahead and make a new high, is where we're having a confirmed bullish trend and bullish structure. So at this point, all you're doing is measuring pullbacks, right? So at the moment that you get this high here, you know that the trend is bullish, which doesn't necessarily mean that you need to buy now. What I would once again advise is you wait for the pullback into the 50% plus, and you can see here that we pull back to the 50% plus and create, and at that point, when we do that into a POI, and you can see you have a unmitigated block here, right? Let's do this here. Let's zoom in right there. Then you can look for a buy position targeting a new higher high, because you know that the 1 hour, which is the example that I've given you, is showing you that it is absolutely bullish, right? And therefore, every time we pull into the 50% plus into a POI, you would look for a long position at that point and ignore the Asian ranges. This is a strategy that I've taught in the past numerous times about the midline test, the manipulation of both sides, and you can see that it still works to this day very, very efficiently. I mean, it does not get any better than this. But anyways, let's actually remove them so it's clear for you. And at that point, you know that you can take a long position targeting a new higher high. So we keep following structure. We then create a new external point here. We go ahead and make a new high there. Now, do we pull back again from here, which is the new external point, to the highest high, which is the new high that we've created? And we can see, yes, right, with this bearish candle, and ignore the POI that I'm watching, we've pulled into the 50% again. So this becomes, once again, your new external point at this point, and you are expecting a new higher high. Once again, it trades into a breaker block here within balance. Actually, does it reach here? Let's actually take a look. I would consider this the breaker. It does barely reach, but you get the point. It is a 50% plus, and you potentially have a fair value gap here that you could have used as an entry to go long and make a new higher high, which is what you're always targeting when you're trading external structure. Now, with that understanding in mind, what are we expecting now? Well, when we look at this, we can see, right, that we now have a new external point here. We're going to take here, and we can see that we've not retraced to the 50%. So these lows here are nothing but liquidity. And you need to be aware of it, because many traders will see this POI and look to buy a retracement into it and expect it to move higher, which is, in my opinion, the wrong analysis to be doing, because it hasn't pulled back to the 50, and more likely than not, this is eventually going to get taken out. What could happen here is that we entice buyers trading above these highs to go long. Then we retrace into the 50 and create a new external structure point, and then we move higher. That could very well be the case here. Now, if you zoom out, you will see that we have a fair value gap here waiting, and that's due to the fact that, once again, as I show you the 4 hour, you will see that the external structure shift. Now we can see that we had a beautiful bearish trend here that you could have taken advantage of, right? At this point, you have a bearish trend, 4 structure points pointing in the same direction. What do? Once again, you look for the external landmarks here. You take it from high to low, and you look for an area to go short above the 50. What do we have? We have an untested order block here. We have a potential breaker there, here, and let's zoom in. And those are your areas to be going short within this price leg, because you know that that's above the 50. You have a bearish trend. There is a high probability that we're going to see the market move lower, right? And that's exactly what's changing now. We've now started to print bullish structure based on the hourly time frame, and we need to expect it's going to continue happening until it no longer does. So let's jump into the 5 minute, because this is where it gets interesting, right? We understood, and now I'm going to remove the drawings, that those are the external points in the structure, right? We have the low here. We're actually going to use a different color so that we can represent it easier. We have a low there. We have a high here. We have, and we're just going to be drawing for, like, don't worry guys, this is going to be quick. Actually, let's do this manually instead. We have a low there, and we have a new higher high there. And this is the conundrum that I spoke about on the drawing. You can see how the market structure on the 5 minute will change from bullish to bearish multiple times, right? We move up, create a high, then we pull back, break structure here, people wanting to short this imbalance here. You can see it works on the short term, but then gets taken out. Why? Because the external structure is telling you that we're now bullish, and any market structure change on the 5 minute, as we do here, is going to be met with external structure expansion, because it's only retracing so that we can create a new external higher low in this case, because we're looking at a bullish trend. And the same thing happens over here. We create a new external higher high. What does structure do? Structure shifts beautifully bearish, and you can see that does maintain for a while, and it continues maintaining until what? Until when? Until when we reach the external point, which is always going to be higher than the previous external, right? You can see that this low here is lower than this low here. Therefore, this becomes a higher low, and the market structure shifts bearish on the 5-minute until the external point is met. Once again, this time we touch into this POI here, and then we resume the trend bullish. So this is how you need to be looking at structure. I know there's a lot of confusion, but this should now be making a lot of sense. Hopefully this was helpful, and I will see you in the next video.